Hey guys, it's Alex Powell here. I want to take a quick second to talk to you guys about what a joint venture actually is. So, a joint venture is different than a business conglomerate where two or more people aren't joining up to start ABC company or Google or whatever the case may be, whatever company that you're starting. A joint venture is where two parties or two more parties for that matter come together, but their identities are still distinct. And that's an important feature, especially when it comes to investing in real estate. Now, there's one really, really important feature that I personally hold very true when it comes to investing in real estate and with joint venture partnerships is that when I'm aiming to partner with somebody, then I'm aiming to find people who bring what I need, as well as I'm hoping that those people who are bringing me on I have what they need. And I think that's a very, very important distinction when it comes to joint venture partnerships. So, the simplest way, I'm going to draw a little diagram here on the screen to break down what a real estate joint venture partnership would theoretically look like. Now, there's a million ways you could structure a joint venture partnership, but this is probably the simplest way to look at it. So let's imagine for a second there were four people who wanted to get into a real estate venture, and all four of them have different skill sets that they can bring to the table that would make theoretically 100% joint venture worth 25, 25, 25, 25. And so if we kind of draw out on a quadrant here. The first one is you'd have what we like to call the finder. Okay, so this is the person who actually goes out there and sources the opportunities, and these are good off-market properties potentially, or even they might be on the market, but they're great properties. Maybe there's some value add, or maybe there's a different way of looking at the project that the average person just missed. Who knows? But a finder is an incredibly important and key asset when it comes to finding great real estate opportunities. Now, the second person is effectively the working partner. Um, so, uh, partner. So that's what I call it. But effectively, it's the person that is going to take that found property and they're going to execute the work on it. So whether that may be coordinating the construction, dealing with the permit process, maybe there's rezoning involved. These are all things that come into play. So that's the first two elements of it. Now the next two come from or have to deal with the financing side. Okay, so on the third person is one I like to call the financer. Okay, so here's the financer. So this is a person that is bringing in the cash. So whether we have to buy the opportunity in cash first, put down a couple $100,000 or fund the renovations, this is the person that's literally dishing out the money that is going to help execute this property. Okay, now that's a very, very important role because that person has to have the capacity to be able to do that, right? And last but not least, four is the mortgage holder. Okay, so the mortgage holder has a very uh, holder. Here we go. The mortgage holder has a very important responsibility, and that is that they are holding the asset and they are mortgaging the asset. So once again, guys, this is a one example of a joint venture. This is not how to do every joint venture. However, this is a very typical way that common real estate investors do joint venture partnerships for smaller multifamily type properties. Now, if we're considering, let's say, a duplex or a triplex or smaller asset, often it's not worthwhile to have four people involved in this project because there's not that much cash flow on some of these properties or that much equity growth that it would justify having four different splits. So, what we typically do is we break this down into two different people, whereas you have the top person being person one, and you have the bottom. Whoop, here we go. It's not coloring here. Person two. So when we break it down as two separate people, you have the working partner and the person who's finding the opportunity as one joint venture in themselves. And we have the financer and the mortgage holder as the other person who is bringing value to that deal. Now, together, two partners can make wild things happen, and we've seen it done, and we've done it so many times. So I can speak very confidently to how well this works.